A business can be wildly profitable on paper, breaking sales records month after month, and still end up starving to death. You can have millions in booked revenue, but if you run out of actual cash, the doors close. Imagine a thriving retail chain. Customers are walking through the doors, you're moving units, and your income statement shows a massive profit margin. Everything looks successful. But your landlord and your suppliers don't accept paper profits. They want their money today. To pay them, you need liquid cash in the bank, ready to deploy. This brings us to a metric called working capital. It's the essential cash buffer a company uses to survive its day-to-day operational obligations, like payroll, rent, and inventory, over the next 12 months. If that buffer runs dry, those impressive profit numbers mean very little. A business that cannot cover its short-term bills eventually faces court-ordered liquidation. To see if a company can actually survive a sudden cash crunch, financial analysts run a liquidity stress test. The most common tool for this is the current ratio. It's a calculation where you take everything a company owns, its current assets, and divide it by everything it owes over the next year, its current liabilities. This diagram shows $60,000 in assets weighed against $30,000 in short-term debt. Divide them for a current ratio of 2.0. The company seems capable of paying bills twice over, but this assumes every asset can instantly pay a bank loan. A high current ratio is misleading if most of those assets are tied up in physical items that might take months to actually sell. You cannot pay your rent with pallets of metal parts or heavy machinery. These physical assets hold value, but that value is trapped. To find a more accurate picture, financial analysts use a stricter metric called the quick ratio, also known as the acid test. It measures a company's capacity for immediate survival. This chart shows the quick ratio. You subtract inventory from your total current assets, then divide the result by your liabilities. Removing unsold inventory often drops a company's ratio below 1.0, signaling it lacks liquid cash to cover immediate obligations. Even the cash you do expect to receive hides a final hurdle: accounts receivable. This is the money that your customers currently owe you for services already rendered. Customer payment delays act as a ticking clock. Every day an invoice goes unpaid, it drains the company's liquidity, freezing cash you need to operate. If a business waits 60 days for its customers to pay, but its own bills are due in 30 days, it will struggle to function. The sales were successful, but the timing was flawed. Surviving in business is about manipulating time, rather than endlessly trying to increase your sales volume. Companies must hold liquid cash for precautionary motives. When sudden economic shocks or spikes in inflation hit your supply chain, only cash on hand will absorb the blow. So how do you manage working capital? First, collect money from your customers as quickly as possible. Second, negotiate with your suppliers. You want to delay paying your own bills for as long as legally and reasonably possible. And finally, avoid letting your cash get tied up in slow-moving inventory that sits untouched in a warehouse. Keeping your assets highly liquid is the only way to reliably pass the acid test. Control the clock, and you keep the business alive.